We had a manic period at the end of July, which carried over into the beginning of August. And it was the first stock market shock that we've seen in a while, and it left some investors just running for the hills. So I'm going to explain what the heck happened and why, along with digging into some of the financial results of the Magnificent Seven stocks and keep you up to date with global interest rates. Hi, I'm George, Finder's investing expert. This month we've partnered with eToro to bring you all of the latest market news and insights from the past month. If you're interested in more content like this, do me a favor, make sure to like below and subscribe to our channel. So, what happened in the global markets that left plenty of investors panicked? Well, it was a bit of a complicated situation with a number of moving pieces, but I'll try and break things down in just the simplest way that I can. The first, fallen domino was to do with the Japanese economy. At the very end of July, the Japanese central bank decided to raise its base interest rate to around 0.25%, and it was only the second rise in 17 years. Now, the problem for the wider market is that this actually strengthened the Japanese yen as a currency, and plenty of big traders had massive bets on the yen remaining weak. The second piece of this puzzle was the US jobs report, which basically gives us an overview and kind of a snapshot of US employment as a whole. And the figures that came out at the beginning of August showed that unemployment had ticked up to 4.3%, and job growth overall had slowed much more than expected. And markets just hate it when things don't go to plan. So whereas the major economic concern of the past few years was inflation, the worry now is that the Federal Reserve has kind of overshot things and are about to cause an economic slowdown or even a recession by keeping the rates higher for longer. This would mean missing the soft landing that investors and economists were hoping for. Okay, so going back to Japan, because the Japanese yen strengthened against the US dollar, this screwed up a lot of massive trades. Because Japan has low interest rates and the US has high interest rates at the moment, a huge amount of money was involved in what's known as carry trades. A carry trade basically involves borrowing money in a low interest rate environment like Japan, and then investing that money for a higher rate of return somewhere else like the US. So what we saw was a huge kind of unwinding of these carry trades due to the currency price change between the yen and the dollar. Now, in isolation, this isn't dreadful, but it does have a knock-on effect. So lots of traders were forced to close their trades or find additional funds to use, which does mean selling down liquid assets like stocks, even if they weren't planning to. And this selling pressure creates a bit of a downward spiral. So we had the combination of a weak outlook for the US economy and a huge number of trades getting flipped on the heads due to unexpected strengthening of the Japanese yen. And this was the worst duo the market has seen since pineapple on pizza. And it sent markets falling pretty heavily in the US, which then tends to drag down the rest of the world with it. Luckily, we did see a fairly fast bounce back, with most markets recovering relatively quickly as investors absorbed this information and decided that most of it was just a decline due to technicalities and the panic was a bit overblown. For any stock pickers out there, you might have grabbed up some bargains during this period of uncertainty. For example, Nvidia reached lows of just under $100 a share, but it's now back up to around about $130 mark. So that's roughly a 30% increase in the quick recovery that happened after these events. Also, if you're a long-term investor who just simply held on, your global portfolio probably wouldn't look much different today. This is why people say not to, check your portfolio constantly if you are in it for the long haul, because you might have seen the drop, particularly on Monday the 5th of August, and panicked, perhaps moving into cash to try and prevent further declines. But then Tuesday the 6th and Thursday the 8th stayed some of the best recovery days, and you would have missed out had you been sat on the side with cash. Much of the US stock market growth in recent years has been down to a bunch of stocks that have been dubbed the Magnificent Seven, which includes Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. We're just coming to the end of this latest earnings season, and apart from Nvidia, we had a flurry of Mag 7 reports released right at the beginning of the month. If you need a quick refresher, an earnings report is a quarterly document that public companies have to release. and it gives real-time financial performance updates from the previous quarter. It's basically part of the deal about being a public company. The public actually need to be able to see what's going on. And earnings season just refers to the period every 3 months or so when we get a flurry of these reports. The key figures that investors look out for are the total quarterly revenue stats, basically just the sales that a company has made before costs are taken into account, and then also the earnings per share, EPS, which is the total profit, also called net income, divided by the number of shares. There's some extra accounting nuances around these, but that's basically the gist. The revenue figure will likely be a large sum, usually in the billions, especially for stocks like the Magnificent Seven. And then the EPS figure will be much smaller, for example, $1.50, because each share is generating $1.50 of profit, which doesn't sound like a lot, but when you times that by the millions of shares that are in circulation, it adds up to a big pile of profit. Apart from those headline figures, investors and analysts will also take a look at how different areas of the business are performing and ideally growing. The results can spook investors or leave them feeling pretty optimistic. Every quarter, all the investing enthusiasts and analysts on Wall Street start theorizing about what they think a company's results will look like. Beating those expectations can be good for a stock price, and falling short of them can be bad. But that's not always the case, and sometimes it just feels like there's no rhyme or reason with share price movement after a report, which is why you can expect more volatility and price swings during these periods, so watch out. Now, for the Magnificent Seven, I'm not going to bore you by listing out all of the stats one by one. You can look those up yourself if you like. Instead, I'll just give you an overview of the key takeaways from these latest financial reports. So, Alphabet, which is Google's owner, released great financial results and did beat expectations, but the stock actually dipped because YouTube, which is owned by Google, saw its ad revenue come in lower than expected, and investors can be a fickle bunch. Alphabet has also been in hot water recently over a monopoly lawsuit, but that's basically a separate issue to the earnings. Amazon smashed profit expectations, but it fell short on revenue expectations because its retail business is having to compete more and more with the likes of Temu and Shein. Apple managed to beat expectations for revenue and profit, with its overall sales rising by 5%, but this wasn't enough to stop Warren Buffett from selling 50% of Berkshire Hathaway's holdings in Apple, and it was its biggest position, and it still is, but it's cut its holdings in half. For Meta, revenue and profit results were strong, showing a massive improvement and growth compared to the results from the same period last year. And it seems like all of the money that they've been pumping into artificial intelligence and AI projects was starting to pay off, instead of just being a big kind of cash sinkhole like its failed crypto project was. Microsoft also released great results, but it wasn't enough to give the stock a boost. And this was because its cloud computing business segment grew significantly, but not enough to woo analysts who were expecting a 31% growth in this area, when Microsoft only managed a 29% growth in the area. So the share price actually dipped. I mean, give them a break. Tesla was actually the first Magnificent Seven stock to report for this past quarter, and it didn't kick things off particularly well. Revenue rose and did beat expectations, but it missed the mark on profit, which led to a share price drop. Nvidia is set to report on the day that we're filming, so here's a quick voice note from future me with some key takeaways.
So in Nvidia's latest earnings report, it actually managed to beat expectations for both revenue and for profit, so the earnings. The revenue was actually up by over 120% compared to the same quarter last year. However, the stock price actually dipped, and it dipped because the growth wasn't enough to kind of excite investors. Some people are worried that the level of growth with Nvidia is actually slowing down, and so it beat expectations, but it didn't beat them by enough in order to drive some kind of positive movement with the share price.
Personally, I think earnings season can present some excellent opportunities for long-term investors, because we tend to see plenty of overreactions where short-term financial results have an outsized impact on a company's stock price. Like in 5 years' time, are we really going to be sat here talking about Microsoft's Azure and cloud services computing revenue growing by 29% instead of 31% in Q2 of 2024? Probably not. Sometimes a stock can go down by more than what's reasonable, meaning you can get in at a decent entry price and then just keep hold for years, giving the stock plenty of time to recover. Of course, there's no guarantee that a stock will completely recover, so just be aware of that and don't invest in a stock simply because the price is down. Make sure that it's an investment that you're confident in buying and that you're happy to hold in your portfolio for a long time. Another important interest rate change took place at the beginning of the month with the Bank of England's decision to finally lower the UK base rate from 5.25% to 5%. This is a positive and a welcome move for the UK economy and for a lot of companies, because it means that companies are going to be able to borrow money for cheaper in order to fuel growth, and it's hopefully going to lead to more positivity and spending across the whole economy, which is good for businesses, and it can actually create a bit of an upward spiral. The downside, however, is that the US Federal Reserve is sticking to its current Fed funds rate at the moment, deciding not to make any changes at the very end of July, when they last kind of sat down to discuss the lay of the land. Sadly, most global investors and markets only really care about what the US is doing, because the UK only makes up a small portion of the global economy and the global stock market. But it does look like we could see lower rates in the US as soon as September at the next Federal Open Market Committee meeting. If that happens, we might see a boost to stock prices in the US and in the UK, because this could mark the beginning of the end of high interest rates. We might also see an uptick in risk on assets when investors are basically just willing to take on more risk with investments like growth and tech stocks that need to borrow lots of money to fuel further growth. And this is possibly going to pour some jet fuel on the artificial intelligence boom. However, as the markets are already pricing in an interest rate cut in the US, it's more likely we'll see a big market movement if they decide not to lower rates, or if they lower rates and then the surrounding language they use is extremely positive or dovish, perhaps hinting at plenty more rates to come. September's definitely going to be an interesting period for the stock market, and it's going to be really fascinating to see where we're at by the end of the month. Hopefully in a better position than today, but who knows. Thanks for watching. Make sure you tune in next month, and if you want to check out our review of top trading apps like eToro, just click the I over in the right hand corner or click here for our latest videos.